All right, let's unpack this. We're checking back in with a company we've explored before on this deep dive, Sersol Berhad. If you joined us for a previous look, you'll remember we were digging into a truly complex and, frankly, pretty precarious situation.
That's absolutely right. Our last deep dive on Sersol that covered their Q3 FY 2025 results. And while the picture was concerning, we saw declining revenue, ongoing losses, that really dramatic insider selling event. And, our assessment of their competitive position was pretty stark. Gave them a financial moat scorecard of, 1 out of 10? They were definitely on shaky ground.
Well, the plot thickens, or maybe it clarifies a bit. They've just released their Q4 FY 2025 results, which brings us right to the close of their financial year. So our mission today is clear. We need to peel back the layers of these latest numbers, compare them against what we saw back in Q3 and previous periods, and really ask the big question. Are we seeing the first hopeful signs of a genuine turnaround for Sersol, or is this just, clever distractions, maybe reshuffling the deck chairs on a ship, still navigating some very rough waters? It's a crucial opportunity for you, our listener, to see how things are really developing on the ground.
Exactly. We'll be meticulously sifting through all the available reports, looking for those trends, performance benchmarks, and critically examining if any of the, significant challenges we talked about before have shifted, or maybe if new factors are coming into play. The goal, as always, is to give you that shortcut to being truly well-informed on Sersol, based strictly on the source material, help you understand the why behind these numbers.
Okay, let's dive straight into the money then. Starting with the top line for Q4 FY 2025, the quarter ending June 30th, 2025, Sersol reported revenue of RM 3.229 million.
Right. And when we place that number in context, an interesting picture starts to emerge. In the immediate preceding quarter, that's Q3 FY 2025, their revenue was RM 3.0111 million. So we do see a slight sequential increase, about RM 0.218 million. So that's a tiny step forward from the last quarter.
A tiny step, okay.
However, if we zoom out and look at the corresponding quarter of the previous year, Q4 FY 2024, revenue then was RM 3.382 million. This means that year over year, revenue has still decreased by about RM 0.153 million for the quarter.
So a tiny step up from last quarter, a sliver of improvement maybe, but still firmly down compared to last year's Q4. I feel like they're trying to climb out a hole, but it's a slow and kind of uneven ascent, isn't it? What does this choppy revenue growth tell us about the underlying market for their core products? Is it demand or are internal challenges still holding them back?
It suggests a bit of a mixed bag, doesn't it? That sequential bump, well, it could indicate some short-term wins or maybe seasonal effects. But the year-over-year decline, that points to persistent weakness in their core business segments, or at least a real struggle to regain that previous momentum. It's certainly not a strong signal of a robust recovery in their traditional markets.
All right, so the top line is, well, struggling. But the real gut punch last time was the bottom line. Have they managed to staunch the bleeding at all there? For Q4 FY 2025, Sersol reported a loss before tax, or LBT, of RM 0.531 million, and the net loss attributable to owners was RM 0.590 million.
That's the critical question, definitely. And we do see an interesting shift here. If you compare it to Q3 FY 2025, where the LBT was RM 0.801 million and the net loss was RM 1.138 million, we're actually seeing a noticeable improvement in both LBT and net loss sequentially. From Q3 to Q4, the LBT decreased from 0.801 million down to 0.531 million, and the net loss decreased from 1.138 million down to 0.590 million. So yes, the bleeding has reduced this quarter.
That is a significant improvement from last quarter. But let's not forget the context here. What about year over year? Looking back at Q4 FY 2024, they actually reported a profit before tax of RM 4.835 million and a net profit of RM 4.833 million. But that profit, it was specifically attributed to let me get this right, a reversal of depreciation amounting to RM 0.751 million and deposits written off amounting to RM 4.707 million that were restated. So even with this sequential improvement, Q4 FY 2025 is still deep in loss territory compared to the previous year's Q4, which really benefited from those big accounting adjustments, didn't it?
Precisely. And this is a crucial distinction to make. While the operational loss is narrowing sequentially, which could indicate a positive shift in cost management or maybe new revenue contributions, the company is still reporting losses overall. And that prior year's profit in Q4 FY 2024 Like you said, it wasn't earned through robust sales or efficient operations. It was a one-time boost, wasn't it? Specifically attributed to those accounting adjustments, essentially. They reversed some old depreciation charges and wrote off some previously doubtful deposits. These are, paper gains, not profits from selling more products or improving operations. It makes that quarter a bit of an anomaly. The real insight here is that while they're patching some financial holes, the core engine isn't yet firing on all cylinders to generate sustained organic profit. Not yet.
We talked about cash burn in our last deep dive. That was a critical concern. What's the latest on their cash situation? At the end of Q4 FY2025, their cash and bank balances stood at a rather precarious RM.757 million, just over $750,000.
Yeah, precarious is the word. If we connect this to the bigger picture, think about this. At the beginning of the financial year, June 30th, 2024, their cash position was RM6.467 million. For the full financial year ended June 30th, 2025, Sersol reported a staggering net decrease in cash and cash equivalents of RM5.714 million. That is a substantial reduction, and it's driven primarily by cash used in operating activities, which amounted to RM7.662 million for the year.
Wow. So despite that sequential narrowing of losses this quarter, the company is still burning through cash from its actual operations. And at a significant rate for the full year. What are the implications of such a rapid cash drain for a company trying to pivot and stabilize like this?
It's absolutely critical for financial sustainability. I mean, really critical. While they did have some positive cash flow from investing activities, RM 2.324 million, partly from selling off some ROU assets, right-of-use assets like leased property or equipment they didn't need anymore, and other investments. But this wasn't nearly enough to offset that operational cash drain. It just underscores the ongoing pressing challenge of achieving positive free cash flow, which is, the lifeblood of any healthy business. They're running on very thin margins of cash right now. Any hiccup could be seriously problematic.
Okay, let's turn our attention to management's perspective. What do they actually say is driving this Q4 performance?
Well, the Q4 FY2025 report, it explicitly states that the loss before tax of RM 0.531 million is mainly due to the decrease in revenue when you compare it year over year. However, a crucial detail emerges when they discuss the improvement from the immediate preceding quarter, Q3 FY2025. The report attributes the decrease in LBT, so the improvement in the loss from RM 0.801 million in Q3 down to RM 0.531 million in Q4, specifically to a, quote, new revenue stream for the money lending business.
Okay, here's where it gets really interesting. The money lending business, we talked about that as a future strategy in our last deep dive, didn't we? And it's already impacting the numbers. That's a surprisingly quick turnaround. But hang on, if management says the overall LBT is still mainly due to decreased revenue year over year, doesn't that kind of suggest this new venture is simply trying to patch a much larger hole in their core business rather than actually fixing it?
That's a very perceptive point. I think you're right. It indicates that while the core revenue from other segments might still be struggling on that year-over-year basis, the money lending segment is already making a positive contribution. It's helping to narrow the operational losses sequentially. It's sort of a testament to the speed of their strategic pivot, isn't it? And it aligns with that approval Happy Capital SDN BHD received back in April 2024 to operate a money lending business, which was mentioned in the Q3 report context. So yes, it's contributing to staunching the bleeding, but it doesn't necessarily mean the underlying wounds in their traditional business have healed. Not by a long shot.
Right. Now, last quarter, we highlighted a really significant and frankly unusual tax expense that hit the net loss hard. Did that persist? And what does it tell us?
Yeah, that was odd. For Q4 FY2025, the income tax expense was RM 59,000. For the full year, it totaled RM 387,000. Now, while that's not as dramatically high as the RM 337,000 we saw in Q3 FY2025 just for that single quarter, it still contributes to the net loss. And like you said, this is unusual for a company in the red. Typically, loss-making companies might get tax credits or refunds. This persistent tax expense suggests there might be non-deductible expenses or perhaps specific tax structures at play that are just eating into their already tight margins.
So even when they're losing money overall, they're still facing a tax bill. That feels like rubbing salt in the wound, really. What does that tell us about their tax planning strategies? Or are there specific types of expenses they're incurring that just aren't tax deductible? This seems like a consistent drain on their resources.
Exactly. It's a fascinating little anomaly, isn't it? It could indicate they have certain revenue streams, maybe from specific subsidiaries or ventures, that are taxable despite the group's overall losses. Or perhaps certain expenses aren't recognized as tax deductible in the current period under tax rules. It's definitely something that warrants a closer look because it directly impacts their net loss, making that path back to profitability even steeper.
Okay. Let's break down where the revenue is actually coming from for this quarter, Q4 2025. Can we see that by geography and business segment?
Yes, we can. Looking at the segmental reporting for Q4 2025, revenue from Malaysia was RM 2.355 million, and from Thailand, it was RM 1.469 million. For the full year, just for context, Malaysia contributed RM 10.660 million, and Thailand brought in RM 5.539 million. Now, in terms of business segments for Q4, coatings manufacturing brought in RM 3.722 million. And then there's an other segment which brought in RM 0.102 million. And this other segment is crucial as it likely includes that new money lending revenue stream that management specifically highlighted as helping to reduce the losses.
Right. So Malaysia is still the primary revenue driver, clearly, but Thailand is a significant contributor too, showing those regional efforts are bearing some fruit. And that other segment, small as it is for the quarter but containing the money lending business, is indeed starting to show up and make a difference on the bottom line, even if not hugely on the top line yet. It paints a picture of a company trying to diversify its revenue base, pretty aggressively it seems. Now, in our last deep dive, we also mentioned a proposed share capital reduction, a big one, RM 35.5 million. What's the status of that? Does it go through?
Yes. This is a massive development, actually. The Q4 FY2025 financial statements show this capital reduction as fully implemented. Done. The company's share capital has been slashed from RM 52.502 million down to RM 17.0002 million, reflecting that RM 35.5 million decrease. And concurrently, their accumulated losses have dramatically decreased from a negative RM 34.972 million to a much smaller negative RM 2.794 million.
Wow, that is a huge move. So it effectively wipes out almost all of their accumulated historical losses. It's like hitting a financial reset button on their balance sheet. But beyond the accounting itself, what does this actually signal to the market, especially given their, history of governance issues we touched on before? Does it truly wipe the slate clean in investors' minds, do you think? Or is it maybe more like putting fresh paint over some crumbling walls?
That's the core question here, isn't it? And on a purely technical level, this is a pretty common strategy for companies bogged down by significant accumulated losses. It essentially cleans up the balance sheet, gets rid of those past deficits on paper. This makes the company appear financially healthier, certainly improves its equity position on the books, and importantly, it can clear the way for potential future dividend payments once profitability is genuinely achieved, something they just couldn't do with those large accumulated losses hanging over them. So it's a technical accounting maneuver designed to reset their equity. It's not a cash-generating event, let's be clear, but it definitely shifts their financial optics. Now, to your point, does it wipe the slate clean while it cleans up the books? Yes. But it doesn't instantly resolve the underlying operational issues or perhaps the trust deficit that might linger from past governance concerns. It's a necessary step for financial hygiene, you could say, but it's definitely not a magic bullet for operational performance or rebuilding trust.
Right, okay. Now, let's talk about those private placements we discussed last time. Their plans to raise more capital. Any updates on the funds raised or how they're being allocated?
Yes, there are updates. The reports clarify that there was a small unutilized balance, only about RM 0.048 million from a previous placement, private placement 2. This money was initially earmarked for buying machinery and equipment. However, the board has now resolved to vary or basically reallocate these unutilized proceeds. They're moving it towards working capital purposes instead. They cited prevailing market conditions and weak market sentiments related to global economic developments as the reason for this shift. And this variation, because it was such a small amount relative to the total placement, didn't require regulatory or shareholder approval.
So they're reallocating funds essentially to keep the lights on, redirecting money from planned future investments to cover immediate operational needs. That speaks volumes about their ongoing cash flow challenges, doesn't it? What about the new proposed private placement we discussed? The one that got approval for 85 million shares. Is that still moving forward?
Well, Bursa Securities, the Malaysian stock exchange, has indeed granted an extension of time. They now have until December 5th, 2025, to complete the implementation of this new private placement. This indicates they still intend to raise more capital, which, again, highlights their need for external funding, but the execution has been delayed, likely due to those same market conditions or perhaps just the complexities involved in getting it done.
Yeah. Any other structural changes to the company itself? Maybe streamlining their operations, getting rid of bits?
Yes, one other thing noted, Sersol Takuni, MSDN BHD, which was a wholly owned subsidiary, was essentially struck off or formally dissolved back on March 24th, 2025. So it ceased to be a subsidiary of the group. This is often a sign that a company is trying to streamline things, probably shedding an underperforming or maybe a non-core asset to simplify the overall group structure and potentially cut down on overheads.
Okay, so thinking back to our previous deep dives, we highlighted some significant internal instability, remember? That board shakeup, auditors flagging potential past irregularities, and that highly unusual insider selling event. Big red flags. How do these corporate maneuvers we just discussed, the huge capital reduction, the reallocation of funds, the subsidiary strike-off, how do they play into that larger narrative? Is Sersol genuinely trying to turn a new leaf here? Are these real efforts to rebuild trust and stability, or are they perhaps still just symptoms of deeper unresolved issues?
That's really insightful, connecting those dots. What's fascinating here is that these actions, particularly that big capital reduction, can definitely be seen as part of management's strenuous efforts to address the legacy of past financial struggles, to clean up the balance sheet. Now, while they don't directly address, say, the insider selling questions or the specific concerns the auditors raised previously, they do demonstrate an active management of the company's financial structure. They're trying to present a more stable and viable entity, at least on paper. However, you have to balance that against the consistent need to reallocate funds just for working capital and the delay in raising new capital. That suggests ongoing operational and market challenges are very real. It really speaks to a company in active, maybe even slightly desperate transition, trying to stabilize its foundation while simultaneously pursuing these new, sometimes quite disparate, growth avenues. It's a very, very tightrope walk they're on.
Okay, so given all this complexity, what are management's plans moving forward after this Q4? What's their stated outlook for the road ahead?
Well, the Q4 report, it reiterates management's commitment to, quote, maintaining operational efficiency and cost management to enhance competitiveness and ensure long-term sustainability. Standard stuff, really. They also say they plan to continue to expand in Thailand regionally, but what's genuinely new and quite specific is their stated plan to expand the product range to include high-quality protective coatings and specialized paints, including the IRR and NIR for the military.
Military-grade coatings.
Wow.
IRR and NIRR, that's infrared reflective and near-infrared reflective coatings, right?
Right.
Incredibly specialized stuff used for camouflage, reducing heat signatures, protecting against detection. That's a very specific and potentially high-value niche to target. And putting that alongside the money lending venture, it truly highlights a multi-pronged diversification strategy. They're branching out both within their traditional coatings area into high-tech stuff and completely outside it with finance. It's quite a pivot.
Exactly. It really suggests they're not just trying to optimize their existing, maybe struggling business. They're actively seeking higher value specialized markets within coatings, aiming for real product differentiation and presumably higher margins. And meanwhile, the money lending business offers a completely new and perhaps faster revenue generating stream, though it comes with its own risks, of course. This is a bold, multi-pronged approach to growth. They're trying to build new pillars of revenue and value where their old ones might be faltering or just not growing fast enough. It's almost an admission, isn't it, that their traditional business isn't cutting it on its own anymore.
Absolutely. Now, in our last deep dive, Sersol received that remarkably stark 1 out of 10 on the financial moat scorecard, signifying almost no sustainable competitive advantages, zero protection. Given these Q4 results, the continued losses, these bold new ventures, the capital restructuring, does that assessment still hold true? Have they managed to build any kind of defensible position yet, even a small one?
It's a fair question. While no new scorecard is explicitly provided in this Q4 report, the evidence we've discussed today doesn't fundamentally change the core issues that underpin that very low score. Remember, a financial moat refers to a sustainable competitive advantage that protects a company's long-term profits and market share from competitors. Think brand power, network effects, high switching costs, unique patents, that sort of thing. Sersol is still grappling with overall losses from its core operations, and while the money lending business shows some early promise as a new revenue stream, it doesn't create a moat for their existing struggling coatings business. That's a separate entity, really. And the push into specialized military coatings, that's a strategy to build a niche, yes, aiming for a future moat perhaps if they can execute well and gain traction. But it's not an existing moat protecting their current operations. Plus, the ongoing need for capital raises and the fact they had to reallocate funds just for working capital, while that suggests strong self-sustaining competitive advantages are simply not yet apparent.
So it sounds like they're desperately trying to construct a moat for the future, digging the foundations maybe. But it's definitely not present in their traditional business right now. And these new ventures, while bold, inherently come with their own set of risks to manage and completely new competitive landscapes to navigate, right? It's not like those fields are empty.
Absolutely. The risks are substantial. There's broad external risks we previously discussed: global economic uncertainty, geopolitical tensions, unpredictable markets, inflationary pressures. They remain highly relevant. They haven't gone away. And while the Q4 report states interim operations weren't significantly affected by seasonal or cyclical factors this quarter, remember they cited weak market sentiments as the reason for reallocating funds for working capital. That clearly points to persistent macro-level challenges impacting them. And internally, look, while the capital reduction is a positive step for the balance sheet on paper, the underlying operational challenges remain. And the shadow of those past governance issues still persists as a factor potentially impacting trust and stability. It really is a high-stakes gamble on these new strategies paying off.
Okay, phew. We've covered a lot of ground in this deep dive into Sersol's Q4 FY 2025 results. Let's try and distill it. Here's what you, our listener, should probably take away, the distilled essence. While revenue saw that slight sequential uptick, it's still down year over year, indicating a persistent struggle in their core business. That hasn't gone away. More positively, the operational losses are narrowing quarter on quarter, helped significantly, it seems, by their new money lending business kicking in. But, and it's a big but, the company's still deep in the red overall for the quarter and the year. And operations continue to burn through cash at what seems like an alarming rate.
That's a good summary. And add to that the significant RM 35.5 million capital reduction. That's a major balance sheet reset. A technical cleanup to address those huge past accumulated losses and maybe, just maybe, pave the way for future dividends if they ever get profitable enough. They're actively managing their capital or trying to pursuing extensions for new share placements, reallocating funds, and they're exploring entirely new growth avenues like the specialized military coatings and the money lending business. However, the previous concerns about their limited competitive moat that 1 out of 10 score feels still relevant and the broader challenging economic environment, those still largely persist. And the company remains highly dependent on external capital to keep going.
So Sersol is clearly a company in active, and I'd say rather dramatic, transformation. Attempting to restructure financially and diversify strategically, almost simultaneously, they're making some undeniably bold moves in money lending business, venturing into highly specialized military coatings. Pretty gutsy stuff. But given their ongoing cash burn, those lingering questions from past governance issues, and the clear need to continually seek new capital and even reallocate existing funds just to operate, here's something for you to mull over. Can these strategic pivots and this significant financial restructuring truly turn the tide for Sersol? Can they create sustainable long-term value? Or are they still just operating on that tightrope, maybe just with a slightly different balancing act? It's really a question of whether these bold moves are genuinely building a viable future or perhaps just buying more time. We really hope this deep dive into Sersol's latest performance has given you invaluable insights, a true shortcut to being well-informed on this complex, evolving story.
Absolutely. And if you found this deep dive helpful, please do click like on the video, leave us a comment with your thoughts or any questions. We genuinely love hearing from you and reading the comments. And of course, be sure to subscribe to the Night Eyes YouTube channel so you don't miss our next deep dive. Your engagement really helps us bring more of these analyses to you.
Until next time, keep digging, keep learning, and stay informed.